All right, thank you for having me. As you can see, the title of my talk is Blockchain Token Sales, Disrupting Venture Capital. So I'll talk about token sales and a little bit about how it's democratizing access to capital. So this is me. I've passed all levels of the CFA and the CAI exams. I have an MBA. Work at Ticketleap here in Philadelphia. I'm the director of finance and risk and analytics. I'm famous in the space for weekinthereum.com. I'm also a co-founder, I'm an advisor to cofound.it, which is essentially it's like token sale marketing and consulting headed towards being a platform for all token sales to happen. So that's my disclosure. I'm also a little known fact. I first had the Philly Ethereum meetup in like July of 2014, I think it was. And I think one person showed up. And so I had two of them, and the other one also had one person show up. And shortly thereafter, I moved to Houston because my wife hates the cold. So I work remotely for Ticketleap.
Hey, check whether everyone can hear you. I'm not sure the speakers work.
Everybody can hear me?
Louder.
Okay, you want me to be louder?
Yeah.
All right. So what is Ethereum, right? Like imagine just like, this analogy is not unique to me. It's like a rocket, an alien ship lands in the middle of a coin field, right? And everybody knows that life has changed. Like blockchains are the alien ship. Life has changed, but we're really still not sure like what exactly it all means, right? We know it's going to be big, but we're still not exactly sure what's going to be the first uses, what's going to take off, what's going to be the killer app. Or are we? Because we know what it's being used for right now. It's being used for crowd sales. Like token sales are disrupting venture capital. It's something like already in this space, I forget the exact numbers somebody came out with, but more people in blockchain are using token sales than are using venture capital, and it's not close. It's like 80-20 or something like that. And even if you do like number of like gross dollars invested in early stage ventures, it's getting to the point where we're in single digits now for token sales as opposed to venture capital investing. So the democratization of who can be a VC and who of access to capital is happening, and it's happening through blockchain. That's the first thing that is being decentralized. So are we in a bubble? No. If anybody doubts my opinion on this issue, let me just dispel that up front. And when I was thinking about like what do you want to hear if you come to a talk on token sales, like it seems to be the first thing people talk about is like, are we in a bubble? And I would say absolutely not. We're not even close, right? Because the fundamental question you have to ask yourself is, Web3 even possibly a revolutionary technology? If it changes the paradigm or not, right? Or if it even could. So if no, if your answer to that question is no, like you may as well go home because I don't even know what we're doing here, right? Like if it's not a revolutionary technology, then of course we're in a bubble, and I don't know, it's not that interesting to me. But if the answer is yes, then we have a lot to talk about. So I looked today, we're at $75 billion in total crypto market cap. I exclude Ripple because I don't consider that to be crypto. So $75 billion, right? In mid-1997, Microsoft was worth $200 billion just by itself. That's like a random data point. I'm not saying that we're at that equivalent point in the cycle, but I mean, I could have picked a million other data points, right? Just as like to compare it to. But I mean, and that's inflation adjusted, of course, but really $75 billion is nothing in the overall like scheme of things for the economy. So if you think this is a big deal, then $75 billion is nothing. So, but, right, like, I'm not blind. And if you look at, like, first of all, many of these projects won't last. Just like the internet, like, that started, when, Netscape. I remember when Netscape IPO'd, I think it got to $5 billion. So probably like $7.5 billion inflation adjusted on its first day. It's not around anymore. Yahoo was the one that lasted for a long time. I guess it's really not, it's sort of being sold off. Tech moves fast. Some of these things won't last, right? I don't think anybody thinks that, like, we've already found the next Google. I mean, maybe we have. We don't know is the point. You can't say for sure. And the same with Web 2. Web 2.0. A lot of those things came and went. And of course, there's some crazy valuations. Like, if you dilute Gnosis, it's at like a $2.7 billion market cap. And it really isn't even live yet. So, oh, that's crazy. Does anybody think that's likely?
But it came out of consensus.
Yeah, and consensus is great, and Gnosis is great, but it's hard to justify that even close. I would say it's probably irrational exuberance combined with people looking at CoinMarketCap and seeing the undiluted value, which is like 230 million, and saying, oh yeah, 230 million, that's relatively speaking reasonable. And like NEM, like I'd only heard of it like a couple days ago. I still haven't even really looked into it to determine what's going on there, but it's at like 2.3 billion. Bytecoin, I've seen from people I trust that it's an abandoned project and it's worth $500 million. So that's a little crazy. I don't know, I would say. Do I?
I'll take it.
Yeah. And in fact, I also saw that it actually has a double spend problem. Like there's a security error because it's abandoned. So yeah, that's a little crazy in my opinion. And Dogecoin is $400 million, which is crazy to me, although I have a soft spot in my heart for Doge, as many people in Ethereum do. So should I short after I show you what I think to be crazy? And you say, like, should I short? Are you shorting? And my answer, of course, is no. Are you crazy? I'm not going to try to fight the upward trend. I mean, history says be very careful. Anytime you're against the trend, that's complicated, right? In markets, it doesn't matter what the intrinsic value is. It only matters, what the market says and what the human psychology in crowds does together. So, why does all this matter? As I said earlier, it's the democratization of who gets to be a VC. So I always kind of wanted to be a VC, and I've applied over my career a few times and never even got an interview. And yet, really, the intellectual challenge of being a VC, I now can have because, I get to look at crypto projects in their infancy and decide, like, would I put money into that? Do I think there's a return there? And personally, I love that because I think it's always the intellectual challenge that has interested me the most. And I mean, I also, as a finance guy, I also like returns, don't get me wrong. But I think even more important is the democratization of access to capital, right? So obviously Silicon Valley, one of the advantages it has is all of the capital that's there. I don't think that, what holds, like Philly consumer startups back is probably more like, the built-in adopters that Silicon Valley has is not there with Philly, right? But there's certainly a lot more access to capital in Silicon Valley. But then you go overseas, you go to Eastern Europe, you go to Asia, a lot of those places really don't have access to capital at all. And Web3, Ethereum, decentralization really offers offers across geographic lines access to capital. And hopefully, also, it'll mean that, VC is kind of clubby and tends to focus on people that, went to Harvard and Stanford and frankly look like VCs look like. So hopefully we'll see a little bit more ethnic and gender diversity in who gets funded as well. I think that is a natural consequence of the democratization of capital, or of access to capital. So this is like what I thought a few months ago is the early use cases. So if you're looking at you want to be a VC, so what is likely, given that Ethereum is hard to use, it's hard to use a blockchain. What has the deepest burning need? And personally, I think it's finance, and I think even gambling is going to be particularly that. And we've seen that there are like 20 gambling projects on Ethereum of different flavors, between just flat out roulette to poker to prediction markets, which I would say is harnessing people's desire to gamble for social good. So not exactly gambling, more like a market. But I think a lot of the early winners are going to be finance and also supply chains. One of my friends, Tyler Smith, has kind of famously said, like, we're gonna disrupt supply chains with blockchain before any mainstream finance case happens. And then, of course, law. I mean, I think that's complicated, but you can certainly see in the future that contract writing can change a little bit, and of course, like real estate, putting things on a blockchain, like titles and things like that. But really, even like when I made this slide, I think it's expanded since then. You have attention tokens. There's a bunch of interesting projects in that space that could disrupt Google and the broken nature of web advertising, where we have these crazy trackers that is like 50% of your data goes to tracking you around the web, and publishers don't get paid and all that. And there's projects out there that are working on that and are having token sales soon. So, emerging asset class, and I stole this from Mona Elisa from Melonport. And this image just has some emerging asset classes in history, right? Where junk bonds once upon a time in the 80s were considered like uninvestable by legit people. ETFs, same thing. Commodities, emerging markets. But she actually missed like the biggest one of all, which is the stock market, because 100 years ago, like legit normal people did not invest in the stock market. That was considered gambling, right? So I would say that we are moving towards an expanded definition of what is an asset, and people that are into finance are, if you can get a return out of it, then finance moves into it. And it wasn't even that long ago that like pension funds didn't invest in the stock market. It was one of the big legislations, I think it was in the 60s or 70s, that, I can't believe I forget the date, that basically gave a safe harbor so that pension funds could invest in the stock market. So not even that long ago was the stock market was an emerging asset class. So, of course, I'm leading to, are tokens an emerging asset class? And I say they are. It's growing. I mean, the sector is growing like crazy. The valuations are attractive. So if you are a founder and you can convince people in crypto that you have an interesting project, you can get attractive valuations, certainly better than you can get in traditional venture capital right now. Finance nerd hat, they're likely to produce excess returns, excess risk-adjusted returns, and possibly even most importantly, from a portfolio management perspective, they tend to be uncorrelated with other asset classes or even negatively correlated, which is really great, because if you think about having your 401k in the stock market, like during financial crises, all correlations go towards one and everything goes down, basically, right? So potentially crypto won't be like that. We really don't know yet. But I can actually see scenarios where in global financial crises, markets melt down, traditional markets, and crypto, skyrockets. By the way, of course, this is not financial advice. That's my disclaimer. I am not your investment advisor. You have to pay me a lot of money for that to be the case. So stop it with the crazy talk, Evan. What are you talking about? Tokens is an emerging asset class that everybody should invest in, or again, not financial advice, but that might be what you're thinking. And I would say, if you're into venture capital, you probably know who at least one of these people are. Fred Wilson, Naval Ravikant, and Mark Andreessen. They're all into tokens. Fred is particularly into tokens, and if you read his blog, he talks about it a lot, especially recently, but has been into it for a long time in Union Square Ventures. The deeper I've gotten into this space, the more I'm impressed at how many strings they pull behind the scenes. Naval, of course, on his Twitter, he talks about it a lot, and he's one of the biggest venture capitalists. And of course, Mark Andreessen joined with an A16Z, or Andreessen Horowitz. They joined with Union Square Ventures and have amended from what I understand, they've amended their agreement so that they could invest in a token hedge fund. And I don't think he's talked so much about it, but he's definitely, and Andreessen Horowitz is definitely investing actively in this space. And I just have a couple of tweets. These are from 2 months ago now, but Fred Wilson saying, I'm a true believer, and Naval saying what I just told you, which is that venture capital firms are getting hip to this. I would say we're still on the bleeding edge of venture capital firms being hip to this, but it is increasingly happening. I see VCs signing up to the newsletter with increasing frequency. So this is just a quick slide about token sale structures. This model, it's sort of evolved as we've gone on, and I would expect that we will see a lot of ways where it will evolve towards traditional venture capital structures, but not in all ways. So it started off with people would sell 20%, and then it became, for a long time, people will sell 80% of their tokens. Ethereum sold something like 80% of its tokens. I think Vitalik got like 1/3% of all the Ether tokens or something like that. I guess it would be more like 1% actually. But for the founder, he got a relatively small piece of it, but as the network has grown, it's certainly been worth it for him. It's then evolved because of the DAO. It's evolved into sell, but put a cap on it. So we're gonna raise $6 million, and for 80% of our tokens. Personally, I hate this because what you're seeing in this space is sales sell out in 10 minutes or less, and hedge funds might want to play the latency arb game, but personally, I don't want to wake up at 3 a.m. in the morning and try to send money to some contract, and risk a typo, because I want to get into a token sale. I really don't think we're going to have that structure for much longer, and a lot of these other ones are variations that we are starting to see. So people are doing two-stage, where they sell a pre-round, a pre-sale, and CoinList has a compliant that they came out with this day, 2 days ago, 3 days ago for compliant pre-sales. There's modified Dutch auctions like Ness that got them a very attractive valuation. So I would think that we will see founders increasingly doing reverse Dutch auctions until the valuations stop being so attractive. But they sold 5% of their tokens for a valuation at the time of like $300 and some million. Of course, we'll also see some continuous issuance. There's been some interesting things being written about that. That's a little out there right now, but we're also seeing some experimentation like CoinList, cofound.it that I'm advising. They're doing a priority pass, so for certain people that basically they know will be users of the network or who invested in Economy, because it's kind of an Economy spinoff, who sent Ether to Economy, they will basically get the right to buy cofound.it tokens without having to wake up at 3 a.m. in the morning and try to beat everybody else to the sale before the cap hits. And Tacoba is also running some interesting experiments. So what should you look for when you are buying a token? So, of course, the two normal venture capital things, right, are total addressable market. How big can this be? How big can this possibly get? What is the market that it's going after? And how much of that market can it get? And if it dominates that market, is there another market, maybe even a bigger market, that it can also dominate? And team, because traditionally on venture capital, you bet on the jockey, not on the horse. I think that's completely true in token sales. The quality of entrepreneur matters, and that's not going to change. What does change is network effects, because when you're buying a token, you're looking for something with a network effect. So if you think about the Web 2 businesses that have been built, so like classic example would be Uber, right? So as an early user of Uber, right, it's essentially just a network. It's a network of people that have cars and want to sell their time and drive you somewhere, and people that want to be driven somewhere. And as Uber's gotten bigger and it wants to increase its profitability, they sort of increase how much they take out of the transaction. So as an early user of Uber, you helped build Uber, or you could use the same thing for Facebook, and your interests are completely different from Uber's interests, right? Like, not only did you not get compensated for helping Uber build whatever it is in valuation, 60 billion these days, you also are increasingly, as time goes on, Uber is going to want to take more out of the transaction, and prices are likely going to rise. So far, we've more seen that it comes out of the driver's end, but that's essentially like market incidents. So essentially, if you are building a network like in Web3 and decentralization, what makes sense is to incentivize your users, right? It solves the chicken and the egg problem that previously building a network has had, and you had to solve it by raising so much money in venture capital. Now you can sell a token, and your users, not only do they benefit as the network grows, but they're also incentivized to do your marketing for you. I think that's pretty great. What to avoid? If there's no reason for the token to exist, if it's just slapped on there, if there's no network effects, and it's, you sort of like, they had a business model and they slapped a token on there. First of all, it's probably a security, and they might have some regulatory risk where the government decides to go after them. I think we will likely see something like that in the future. And crypto economic models that don't make sense, prefer not to say who, but one of the bigger projects, I think, in this space, I don't necessarily think their model makes sense. So you got to think through that. And I apparently token sales. Yeah, that's a typo. And sloppy token sales. One of the things you get to judge people on is not only the code they have, but also how they run their sale. And the people that can't run a competent sale, to me, is definitely a yellow flag. And there are also some models for customer acquisition, I'd say, that, as I said earlier, when you're dealing with the blockchain, you have to abstract that away for users because it's still tough to use. So you have to identify customers or users that really have a burning need. So if you want to do your own, we can talk more about this. I figure we'll get some questions. But join the community. I would say, the successful projects that raise money, they generally have been in the community. They generally are part of their meetups. They go to conferences. They've met people person to person. Can you tell I work for a ticketing company? I think everybody should go to conferences. And I definitely, having seen what projects raise money successfully, I would say that going to conferences and having had a face-to-face interaction with funders is huge. And the funny thing about this space is that you don't necessarily know who the whales are, right? You could be talking to somebody and they might have 100,000 Ether, and they, of course, are a hacker, so they're wearing ripped jeans and a hoodie, and they're not going to be wearing a suit like in traditional venture capital. So find out more, read white papers. Week in Ethereum, I would say I have a calendar in there, and I'm about to start my own as well. So I will probably in the next week have my own token sale calendar that I put out. I also recommend the Coin Fund Slack, and if you just Google that, you can find it. But it's a crazy fast growing community of people that are interested in token sales. When I joined, I think it had 400 people, and that was only a few months ago, and I resisted joining for a while because I have too many Slack channels already. But it's a great resource for information. And of course, there's really no substitute for reading white papers and going over the crypto economic model. Does it make sense? Is there a user that has this need that really wants this? Will they buy a token? Will they use the token? All that sort of thing.